Wall Street's largest asset manager just put its name on a fund that promises to bring trillions of dollars of traditional finance onto public blockchains. Larry Fink, the man who once called Bitcoin an index of money laundering, now says every stock, every bond, every fund, and every asset on the planet can and will be tokenized. The marketing pitch is extraordinary: 24/7 liquidity, instant settlement, fractional ownership, and a flood of institutional capital that will send base layer token prices to the moon. But buried inside his letter to investors is a single sentence that changes everything. He wrote that tokenized funds will become as familiar as ETFs, provided, in his words, they crack one critical problem: identity verification. That is not a footnote. It does enormous heavy lifting. Because what Wall Street is quietly building is not a bridge that brings traditional finance onto crypto's terms. It is a compliance architecture designed to bring crypto onto theirs. Today on Web3 Verse, Alex is breaking down what is really happening inside the tokenization wave, and what it means for everything you are holding right now. Let's get into it. First, the numbers behind Wall Street's tokenization push are genuinely staggering and deserve to be taken seriously. BlackRock, the world's largest asset manager with $11.5 trillion under management, launched its tokenized money market fund, which has grown to over $1.8 billion in assets. JP Morgan's blockchain division has processed over $1 trillion in transactions through its settlement infrastructure. Citigroup has deployed token services for cross-border payments and published widely cited projections that the tokenized asset market could reach $4 to $5 trillion by 2030. The broader tokenized treasury market has already crossed $7.3 billion, up 256% in a single year. The stated benefits from every institution are efficiency, instant settlement instead of two-day clearing cycles, programmable collateral instead of static balance sheets, round-the-clock liquidity for assets that currently freeze on weekends. On the surface, this all sounds genuinely transformative. Retail investors and crypto communities have largely been cheering it on, operating on the assumption that trillions in traditional assets flowing onto public blockchains is straightforwardly bullish for ETH, SOL, and every other base layer token. More utility means more demand for block space. It is a clean, logical narrative. The problem is that if you read the actual fine print of how these tokenized assets are permitted to move, a very different picture emerges. Wall Street cannot legally allow a tokenized treasury bill to be anonymously traded by a pseudonymous wallet. Securities law and anti-money laundering regulations prohibit it. So every single institutional tokenized product is wrapped in a smart contract standard that enforces strict identity verification and compliance whitelisting at the wallet level before any transfer can execute. The dominant standard for this is called ERC-3643. Originally developed by a Luxembourg company called Tokenization Solutions, it is built specifically to make permission tokens deployable on Ethereum's permissionless base layer. Here is how it works. A standard token is permissionless by default. Anyone can send it, anyone can receive it, no contract checks your identity first. ERC-3643 reverses that logic entirely. Every transfer is routed through an on-chain identity contract that checks whether both sender and receiver have been verified and whitelisted by a trusted issuer. If your wallet address is not on the approved list, the transfer fails automatically before a single token moves. The administrator of that whitelist has even more alarming powers built directly into the standard. They can freeze individual addresses. They can execute forced transfers of tokens without the holder's consent. They can even recover tokens from wallets whose private keys have been lost. Tokeny now powers over $32 billion in tokenized assets using this architecture. The Depository Trust and Clearing Corporation joined the ERC-3643 Association in March 2025. This is not a fringe experiment. It is rapidly becoming the standard compliance layer for institutional tokenization globally. BlackRock's tokenized fund is the most powerful real-world case study. It holds US Treasury bills and generates yield, deployed on Ethereum. The smart contract contains a built-in whitelist mapping approved investor wallet addresses. Any transfer to an address not on that list is automatically rejected. The company managing that whitelist is a firm BlackRock has made a strategic investment in and placed on its own board. The minimum investment is $5 million in USDC. The minimum redemption is $250,000. This is not retail DeFi. It is a gated institutional product that happens to run on a public blockchain. And in early 2026, BlackRock announced a partnership to list this fund on a leading decentralized exchange. On the surface, a trillion-dollar asset manager bringing a regulated product onto a permissionless protocol sounds like a landmark moment. Except that is not what is actually happening. Only wallet addresses that have already passed the verification process can hold the tokens. The decentralized exchange infrastructure is being used purely as an execution layer. The compliance layer sits above it, filtering who can participate before any trade executes. The permissionless protocol is being rented out to run a permissioned financial product. This pattern is playing out across the entire ecosystem. Aave, the world's largest decentralized lending protocol, built a fully permissioned version of itself where every user had to be whitelisted by a regulated custodian before accessing liquidity pools. That custodian was given governance veto power over proposals it judged compliance risks, a centralized override embedded in a supposedly decentralized protocol. Aave has since doubled down with a new permissioned market for tokenized real-world assets enforcing compliance rules across chains. Chainlink's cross-chain infrastructure now deploys what it calls an automated compliance engine enforcing identity verification policies as assets move between blockchains. Partners using this system include JP Morgan, major Swiss banks, and notably Chainalysis, the firm governments worldwide use to track and analyze crypto transactions. Chainalysis is now embedded directly into the cross-chain compliance layer. 60 blockchain networks are connected to this system. The permissionless movement of value across chains is quietly being replaced by permissioned movement filtered through institutional compliance infrastructure. The historical warning signs are already on record. Following the sanctioning of Tornado Cash in late 2022, 80% of blocks on the Ethereum network were censoring transactions to comply with US Treasury regulations. That censorship required no protocol upgrade. It only required a handful of private relay operators to make a commercial decision about which transactions they would process. Centralization wearing the mask of decentralization. Bitcoin was created so that no government or bank could control money. Ethereum was built to run unstoppable applications. The entire promise of this technology was the ability to transact without asking permission from gatekeepers. Now those same gatekeepers are walking through the front door wearing the mask of institutional adoption, and much of the market is cheering them on because prices go up. The efficiency gains from tokenization are real. The yield case for on-chain treasuries at current rates is real. And if you hold tokens with genuine revenue-sharing mechanisms tied to real-world asset adoption, a case can be made that this trend works in your favor. But Wall Street's version of DeFi is not DeFi. It is permissioned finance running on public rails where every participant is identified, every transaction is screened, and the whitelist administrators have the technical power to freeze your assets and reverse your transfers. The endgame of the tokenization narrative is not to liberate traditional finance using crypto. It is to absorb crypto into the traditional financial surveillance state, not through legislation, but through institutional liquidity flooding into protocols that bend to compliance demands, slowly reorienting what DeFi is supposed to be until the original version is not destroyed, but simply forgotten. That is everything for today on Web3 Verse. Drop your thoughts in the comments and we will see you in the next one.